Mahindra Finance, which is one of the country's largest tractor financing companies, and of course a bunch of other vehicle financing opportunities as well, has reported its results last week. Now, what we understand is that the problems that were there in the December quarter have more or less sort of softened themselves in the January-March quarter. We are joined in with Mr. Ramesh Iyer, the Vice Chairman and Managing Director of Mahindra Finance. Mr. Iyer, welcome to this conversation. Firstly, let me briefly touch upon the results because it's been a few days since the numbers are out, and there is plenty of analysis in the market. Your profit number, while it came down on a year-on-year basis, has improved significantly on a quarterly basis. What would you give as a reason for this improvement, sir?
I think the overall quarter has been very exciting. And when we kind of closed the third quarter and we had the discussions, we had mentioned that December standalone reflected how the fourth quarter is likely to be, because December did show a turnaround story. So if you look at each line item, there has been improvement in margin arising out of borrowing cost coming down. We've clearly seen collection improvement from the moratorium given contract as well as from other contracts. The gross NPAs have come down, and the cost that we were focusing on has also remained kind of controlled and subdued. Put all this together has clearly led to a much higher profitability. Just one highlight I would like to bring out very clearly is we have taken a much higher additional provision of about 1,300 crores to bring down the net NPA to below 4%, barring which otherwise the profits would have been substantially higher even compared to the year. So I would think it was overall a very satisfying year. Yes, AUM has degrown clearly, but that's at the back of good collections, shrinking the number of accounts getting free, but against that, the disbursements not picking up.
Okay. I'll address each of these points one after the other. So you mentioned about provisioning as well as the improvement in asset quality. You said that the collection numbers have improved not just from the regular business, but also from the accounts which are under moratorium last year. If you just throw some light, share some numbers as to where does the collection efficiency stand as of now?
So if you look at the fourth quarter, the collection efficiency was slightly above 100% for the quarter. And for the month of March, it was as high as 109, 110%, which was kind of like last March number. If you look at our gross NPA value, in terms of value, 5,700 odd crore, which is exactly the same number that we had 1 year back in March 20. From the moratorium account, we have found upward of 96% of the people have actually serviced their loan. So if you put all of this together, I think the cash flows have really held up. And at the back of good agri cash flow and infra opening up, I think the overall cash flow in rural did play a significant role in this collections.
All right. In terms of the provisioning and the effective, net NPA coming down to about 4%, some of the analysts pointed out that this was in line with what the RBI expected. Just wanted to get a sense, had the RBI been in touch with the company? Was there any target sort of given to Mahindra Finance?
So I'll put it as this, given such a high capital adequacy that we carry, and given the overall environment around, the expectation from large companies like ours will always be, can you consider higher provision and keep the net NPAs at much lower levels? And therefore, the target of 4% was something that we were working on very clearly. And we think that making this additional provision helps us bring down to the net 4%. And we should all recognize that these are provisions. And we all expect that the market conditions will improve over a period of time. And, the customer starts repaying and you get the benefit.
Okay. 1,300 odd crore worth of provisions. Now, of course, this was significantly larger than what the market was expecting in general. And of course, this has a direct impact on the profitability of the company. Want to get a sense, is this probably the end of these elevated provisions in light of COVID, or is the current year also looking a little more uncertain as compared to last year?
So if you look at last year, all the quarters we went on adding additional provision towards overlay. And we currently carry, including this 1,300 crores, upward of about 2,000 crores of additional provision. Now, if things were to be absolutely normal, I think we are more than covered, because if you look at our coverage ratio is about 58, 59%, right? But I personally believe that this first 2 quarters is going to be very challenging, given the widespread of pandemic across the country. It's gone a little deeper. And more than anything else, it's the sentiments of consumer and the sentiments of the employee working out there is something that we'll have to recognize as something that we'll have to live with for some time. We all do expect that by sometime mid-May or so, this problem should get addressed, and it would take another a month or so for things to completely get normalized and economic activity to come back to full force. So I would think somewhere from the second quarter, you will start seeing improvement, but definitely the last 2 quarters starting the festival season should be one of the best.
Okay. Considering that the AUM is shrinking, on a sequential basis, what would you say will first start showing improvement? Is it your provision numbers come down because the general expectation is that things will improve, or is it the asset quality numbers themselves which start showing an improvement?
I think, this market is very unique, the rural market. Both disbursements and collections go hand in hand.
Yeah.
How does one pay only when they have sufficient money, and when do they have sufficient money? When they're earning from the assets they put to use.
Correct.
Right. So therefore, more asset addition starts to happen. So as I said, we have started seeing the collection improvements because the sentiments are low. People aren't acquiring enough assets, is what my belief is. But the demand is definitely there. If you look at when we ended the festival season, October, November, we did see large volumes happening, but vehicles were not available. Now that the vehicles will be made available, I think the agri is doing well. The monsoons are expected to be average plus. The infra story is all beginning to happen. I would very strongly think first the asset growth will also be witnessed very, very surely by the festival season, when on even the collections will be.
Quick, commentary as far as your business is concerned. Now, of course, you said that there is demand in the market for vehicles. It's understandable because of the pandemic. You would expect people to want private vehicles of their own. But the core business, the tractor business, the growth is there, but it's still comparatively lower than maybe your utility vehicle business, which has grown about 18%.
So if you see, tractor has been doing well for now more than 12 months, 15 months. Even last year was good for tractor. And once the infra opens up, you will see contracting segment buying tractor big time. And that is definitely likely to happen. So far, what we are seeing largely, I would think, is agri-based buying that's happening. The contracting segment will start buying and the replacement market will kick in, right? So when contracting segment starts to buy, they do start exchanging their old tractors and more new tractors get bought. So I would very, very strongly think tractor growth will also stay, and you can see, we can witness growth of tractors even going forward.
Okay. If you look at the line items and the kind of growth in each individual business segment that's there, utility vehicles growing strongly. There's passenger vehicles, which is growing about 10-11%, which is still lower than what was there previously, but still it's a strong amount of growth. Is this a conscious shift to move away from tractors as your core business, or would you like to be addressed as a tractor financier in general?
If you look at our balance sheet for any number of years, the mix of product has remained almost the same. The absolute volume is an outcome of how much does the dealer sell or an OEM sell.
Yeah.
But if you look at the mix of the balance sheet, 17-18% still tractor. You look at about 25% is still car. 25% is 25-30%. Close to that is utility vehicle, right? Then you have 5-7% of commercial vehicle. Then 5-8% of pre-owned vehicle. So that mix has not changed. So these numbers keeps alternating based on the volumes available in that market. So we will continue to remain, and we would want to continue to remain a very strong tractor financial. We got into this business 20 years back, and we're holding that position for long. And we would continue to do so while we are doing everything else. Our growth story or our growth engine is going to be by deeper penetration. So if you look at in the fourth quarter, we have added actually 150 branches additionally, and that's going to help us go further. And we are engaged with our existing customers, and through them, we are self-generating a lot of volumes in pre-owned vehicle. That's going to be the growth engine. The commercial vehicle segment has not done too well for the last 12 months, 15 months. And we do expect that post-festival season, as economy picks up, contracting segment picks up, you'll start seeing commercial vehicle pick up. So put all this together, I think our growth will come from multi-product and not any single product, while the mix of would remain where it is.
Right. Speaking about the commercial vehicles segment, a lot of lenders are as you said, multi-product lenders. They seem to be moving away from the commercial vehicle because obviously there's considerable risk, and in the environment you may not have demand. You probably would have higher delinquencies there. But is that a sort of business which is very seasonal for you, and you would only focus on it when sort of the market comes back to normal?
So first and foremost, we are not a very significant player.
Yeah.
And we don't finance large fleet operators because that's not our value proposition at all. So we are looking at, and we have been financing only 1 to 5 vehicle owner, maybe 7, 8 vehicle owner. And those consumers are still not coming back to buy, right? Because they all, invariably attach the vehicle in the market, attach with fleet operators. So when the large fleet operator themselves do not have enough capacity utilization, they're not going to be engaging attaching vehicles. So we would wait for that segment of market to open up, and which I believe should open up in the 6 to 8 months time from now. But until then, it will be small commercial vehicle, the LCV kind of a vehicle, which is fun, and we are doing well on that segment.
Okay. Coming back to the asset quality point, you said 4% was the target that you were working with, and you've achieved that now. So is there a new target to bring it down further?
So clearly look at the target. We may take whatever excitingly we want to do, even much lower than that. But one should recognize the segment of consumer we work with. These are all the earn and pay segment, and it has its own cyclic impact. And invariably in the rural market, first and second quarter is never a great economic quarter because the harvest would have just got over already. And then only post monsoon things become, not like it. So high, climatic impact, extreme summer, then monsoon sets in. And it is historic. You can see any 10, 15, 20 years in our book, you'll see first 2 quarters, you will see inching up, and then it starts to decline. If things get to normal on its own, I think the current NPA book is adequately or even provided more for. So the real game is going to be how do we control forward flow of NPA by a better collection. And that would happen naturally when the collections improve, and which I am expecting definitely post-monsoon, you would see substantial cash flow improvement in the market, which will lead to good collections.
Okay, fair enough. Last few questions on as far as your restructuring book is concerned. Now, you've not seen that much, inflow in terms of accounts which have restructured, right? If I'm not wrong.
That's right. We have not done any. We have just done 60 crores worth, very small. That also SME segment.
Right. Okay. But the industry seems to be asking the regulator to extend the one-time restructuring schemes that were announced last year, and then of course they ran out as of 31st of December. What is the benefit? I mean, it's not like people very aggressively use that scheme. So why is it being asked to come back?
No. So last year, if you look at, first was moratorium, and then came restructuring. So we had this thought in our mind: consumers to whom you have given moratorium, if subsequently you are going to give a restructuring to them, they will be under huge burden of interest both ways. And therefore, we resorted to holding the overdue in our book and allowing the customer to pay as and when the consumer starts earning little better. And that's what we have seen, a good improvement in the moratorium account collections as well. But in this round, I think the ask is, it is not moratorium and restructuring, right? I think the industry is talking about give us restructuring so that the customers can be given a smaller EMI size as well as a little longer period to repay, because that's the ask of the consumer. We are at the end of the day consolidating what a consumer is asking and taking it to the regulator or to the ministry and asking for it. It's not our thought process. So clearly, restructuring will help consumer bring down the EMI size, because their earnings are not going to come back to normal with a speed. So they will need little longer. Until then, you give them a smaller EMI. And as you bring down the EMI, you'll have to extend the period.
So, what has the regulator said on its part? I mean, has there been any form of communication from the RBI?
Oh no, it's too early. We've kind of just about representing it to them. I'm sure they will have this understanding. They will know what the market is. They will know what the consumers' needs are. And last time, whatever announcements were made by the regulator, they were all done much before even the industry asked for it.
Yeah.
So I would very strongly believe that the regulator is in understanding of everything that's happening. And if they may not even wait for us to really ask, before that you would see things come up.
Okay. Keeping in mind the current environment, keeping in mind the pace at which vaccination is happening across the country, and the second wave, which is still holding strong. I mean, it's not like, maybe some states have shown a little bit of a decline, but it's not that overall there has been some major improvement. Keeping in mind all of these factors, what does the rest of the year look like for Mahindra Finance? You said that probably post June is when you start seeing an improvement in the business. But what is March 2022 going to look like?
So March 22 will have to be kind of looked at in two ways. What was April to September and what is October to March. We would like to look at it that way. I very strongly think that, this year, the first 6 months, while it may register some growth over previous year 6 months, but the sentiments have to return to normal. As I said, this is the first time we're seeing spread across the country, going a little deeper. So therefore, the sentiments are low from a consumer side. But with the vaccination speed with which the wave is going on, I think people would feel more confident to return back to normalcy. And I think by May, we should see control of the current situation will also start to happen. So sometime post July, you will see positivity return back. And once the infra story opens up post monsoon, and monsoon turns out to be average plus, which is what is predicted, that monsoon would be good this year too. So with a good harvest and a good infra, I think October to March will be phenomenally a good period.
All right, Mr. Iyer, thank you so much for joining us on this conversation, and we will reconnect again once the next quarter results come in to try and understand where things stand as of now.
Sure. Thank you.
Thank you, sir.
Thank you very much.